3 most effective money management tips. Have you ever experienced a margin call? If so, then this video is the solution for you. In this video, we will provide 3 highly effective money management tips to avoid margin calls. In this video, we will also provide a table that you can use to organize regular lots, which will help you avoid margin calls. So, stay tuned to this video and don't forget to support this channel by liking and subscribing. Hello everyone, welcome to Forex Crypto Backtesting channel. A margin call is one of the most common challenges faced by traders. To prevent margin calls, we need to pay attention to several factors that lead to them. Typically, margin calls result from excessive lot usage and our own greedy nature. In the pursuit of instant profits, traders often overlook fundamental aspects of trading. In addition to having a good trading plan and trading psychology, effective money management is crucial to avoiding margin calls. In this video, we will focus on 3 highly effective money management tips to avoid margin calls. 1. Initial capital. Determining the initial capital significantly influences a trader's psychological strength. Initial capital is the foundation of our trading strength, and having an adequate amount is essential when trading in the market. This means that the prepared capital should not be too small. As trading inherently involves uncertainties, having a sufficiently sized capital allows for recovery from trading errors. 2. Trading plan. A trading plan outlines the strategy we will use when trading. Understanding when to enter a position, setting target stop loss and take profit levels are crucial when trading in the market. For example, using a risk-to-reward ratio of 1 to 2 means that 1 take profit equals 2 stop loss instances. Balancing the number of profitable and losing positions is essential. Additionally, trading strategies can be found on this channel. 3. Lot size. Lot size significantly impacts our trading. Using excessive lots makes our positions susceptible to margin calls. Therefore, it's crucial to adjust lot size based on our capital. You can use the provided lot size adjustment table, downloadable from the link in the description. This table helps you manage your risk profile. Before discussing how to fill in this table, let's go over its components. Start and end test columns. Used for backtesting, indicating the start and end dates. Time frame. Specify the time frame used in your trading. Risk to reward ratio. Describe the ratio you'll use. Stop loss. Fill in based on your trading plan's stop loss risk. Profit/loss. Calculate based on your risk and reward ratio. Lot entry. Automatically calculates lot sizes based on your entered data. Profit/loss. Estimate profits or losses. Balance. Calculate your equity based on completed trades. Account growth chart. Illustrates your account growth. Win rate. Displays total trades, wins, losses, and win rate during backtesting or trading. Profit/loss and account growth. Provides data on profits in pips or selected currency and account growth. Consecutive wins and losses. Shows the largest win and loss in a single trade and consecutive wins and losses. To fill in this table, you just need to follow these steps. The first step is to enter the initial capital amount you are using. For example, in this case, let's use $1,000. Then, input values in the stop loss and take profit columns. For example, assume, according to the trading plan we are using, we will enter a buy position with a risk-to-reward ratio of 1 to 2. Measure the distance between the entry point and the stop loss point. In this example, let's say the distance from the entry point to the stop loss is 30 pips. Enter 30 in the stop loss column. Since we are using a 1 to 2 risk-to-reward ratio, our target take profit is 60 pips. Enter 60 in the profit column. The ideal lot size will automatically appear. Then, you just need to choose your respective risk profile. If the entry reaches the target take profit, leave the take profit value as a positive number. However, if a stop loss is hit, add a minus sign in front of the number in the profit or loss column. Discipline is the key to achieving consistent profits. That concludes our video for today. See you in the next one.